Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and here I am on the edge of the Sydney waterfront because I believe despite the big losses already seen in the stock market this week, we are again, or this year I meant to say, all through the year, and people forget, it's been all the people saying buy the dip have been wrong again and again and again. Eventually they will be right. But I would warn you, having said in the first week of January that you should be selling all and protecting all of your assets, all of your investment portfolio, shorting equities, and we're well down. We've seen as much as 20% declines. I really want to say that even after those huge losses, I am still concerned we will see a further 20 to 30% decline in stock prices, and that is in the US market, the Australian market, and perhaps even more so in European stocks. Now, a lot of people continue to try, as I've mentioned many times on my show, continue to try to look across the valley, say all the bad news is priced in. But there is a scenario there that no one's priced in. So if you want to hear it here first, there is a risk that the US is going to go into depression. There is a risk Australia will have a surprise recession. There is a risk Europe will go into a depression. Now, I use the depression word because the US and Europe are already well and truly headed into recession. And my concern is it could be even worse than even this bearish forecaster has anticipated. In the first week of January, in fact in December last year, and this is before the Ukraine war had begun, I said we would be seeing the Federal Reserve, the RBA, other banks attack the inflation curve far too late, well behind the curve, and they would be doing so aggressively and dangerously impact the economic outlook for those economies. It would be a doubling up on the inflation prices because unlike previous inflation spikes, on this occasion it's supply driven, not demand driven, and therefore raising interest rates is precisely the wrong thing to do. What central banks should have done, the Federal Reserve and the RBA, is to have gently raised interest rates from June last year, which is when I was saying this, and then they would have had to raise rates about a third as much as they have to now, and it would have been a gentle process that didn't spook consumers and business owners and mortgage holders alike. So there's been a lot of mistakes here by the people who are supposed to know better, and I really want to give you the advice that the people who you think should know better rarely do. And thinking for oneself, what I call lookout window economics, is really the best advice I could ever give you. Think independently, look around you at the economy. What I see at the moment is a period where people were overly enthusiastic, overly confident. That's come to an end, and there's going to be a normal corrective process. Now, in the first week of January, and this is what I started to say to you earlier in my little talk, I did say this correction would be a 6 to 18 month correction, 20 to 30%, but I said there was the risk that it could turn into a 3 to 6 year correction as deep as 40 or 50%, and for all we know, it could even go to 60% over a 6 year correction. What I'm highlighting here to you is that despite the big falls we've seen, a much worse economic outcome for the United States and Europe is not at all priced into the market, and the pricing in of that will come behind the curve. Remember, in the GFC, Wall Street started the economic slowdown and the crisis. It was completely engineered by the Goldman Sachs of the world, who sold really untoward products at great length and depth across the world, in fact triggering the sovereign debt crisis in Europe, which was more of a Wall Street investment bank making event than it had to do with Europe itself. But the economic slowdown was triggered by Wall Street. This time around, and what Wall Street isn't understanding, is that the economic downturn is happening in the real world, in manufacturing on Main Street, and is not being driven by Wall Street. And in fact, it is Wall Street that is behind the curve on this and not fully appreciating the dynamics of what's going on. So Wall Street is recognizing behind the curve that there is a real world economic problem. And unfortunately, it looks like that situation is only going to intensify across Europe, the United States, Australia, perhaps Canada, Asia, Middle East, Africa, South America will be impacted, but to a lesser degree than those major two economies, and China is just settling into a much slower growth path permanently. Thank you very much for watching. Clifford Bennett, Chief Economist, ACY Securities.